The unthinkable just happened. December 17th wasn't just another trading day. It was the day Wall Street's most protected secret exploded into the open. Silver didn't just climb past $65. It detonated through that level like it was made of tissue paper, reaching an intraday high of $66.50 before settling back to where we are right now at $65.80. And if you think this is just another spike that's going to fade by Friday, you need to understand something crucial. What happened today wasn't a fluke. It wasn't a pump. It was a structural break in a system that has been held together with duct tape and denial for over 4 decades. Welcome to Finance Folder, where we break down the stories Wall Street doesn't want you to understand. If this analysis helps you see through the noise, hit that like button and subscribe, because what I'm about to show you is going to fundamentally change how you view the precious metals market. This isn't conspiracy theory, this is market mechanics, this is mathematics. And the math just turned catastrophic for some of the largest financial institutions on planet Earth. Let's start with what actually caused this explosive move. You need to understand that silver didn't rally because of some random buying pressure or a sudden surge in investor sentiment. This move was mechanical, it was algorithmic, it was the inevitable result of a trap that has been building for months. The banks have been selling call options at the $65 strike price, collecting premium after premium, betting that silver would never reach that level. These weren't small positions. We're talking about tens of thousands of contracts representing hundreds of millions of ounces. As long as silver stayed below $65, these options expired worthless, and the banks pocketed the premium. Easy money. But the second silver crossed $65, everything changed. This is where delta hedging comes into play. When a call option moves into the money, the seller of that option, typically a market maker or a bank, has to hedge their exposure. They do this by buying the underlying asset, in this case, silver futures. The problem is that when you have massive amounts of options suddenly going into the money all at once, you create a cascading wave of forced buying. The market maker's computer sees the risk exposure exploding and automatically starts buying futures to cover. But that buying pushes the price higher, which brings even more options into the money, which forces even more buying. This is the delta squeeze, and it's exactly what sent silver from $65 to $66.50 in a matter of hours. Now here's what most people don't realize. This wasn't organic buying. There wasn't some massive influx of retail investors or industrial buyers pushing the price up. This was purely mechanical. Algorithms buying to hedge risk, machines reacting to other machines, and once that feedback loop starts, it doesn't stop until the buying exhausts itself or until someone manually intervenes. That's why the move was so fast and so violent. There were no sellers at those levels because everyone was caught off guard. The market makers were scrambling, the banks were in panic mode, and the price went vertical. But now we're sitting at $65.80, pulled back from that $66.50 high, and I can already hear the doubt creeping into your mind. You're wondering if this was the top. You're asking yourself if this is just going to reverse and crash back down like it has so many times before. You're looking at that red candle and thinking, maybe you should take profits before it's too late. Stop, breathe, and listen to what I'm about to tell you. This pullback is not a failure. It's a feature. In technical analysis, there's a concept called support and resistance flip. When a price breaks through a major resistance level, that level is supposed to become the new support. For months, $65 was the ceiling. Every attempt to break it was smacked down. It was the line the banks defended with everything they had. But today, we broke through. And now, the market is doing exactly what it's supposed to do. It's testing that old resistance to see if it can hold as new support. Think of it like this. You've been trying to climb over a wall for months. Every time you get close, someone pushes you back down. But today, you finally made it over. Now you're standing on the other side, and you're stomping on the top of that wall to make sure it's solid. That's what this pullback to $65-80 is. It's the market testing the strength of this new floor. If we can hold above $65 through the end of the day, through the end of the week, it sends a massive signal to every trader, every algorithm, every institution watching this market. It tells them that $65 is no longer the place to sell. It's the place to buy. However, and this is critical, if we drop back below $65 and close under that level, that's called a failed breakout. It means the sellers are still in control. It means the bank successfully defended the line, and we're likely headed back down to test lower support levels. So right now, we're in no man's land. We've got about 80 cents of cushion above that critical $65 threshold, and the battle is raging. Do not get complacent. Do not assume this breakout is confirmed until we see a daily close above $65. That's when you can start celebrating. That's when you know the coast is clear. Now, let's talk about the entity everyone's been speculating about for weeks, the whale. A few weeks ago, we saw a massive buyer step into the market and absorb over $650 million worth of silver around the $63 level. People have been asking, where did they go? Did they dump their position into this rally? Did they sell at $66.50 and walk away with a quick profit? I've been watching the order flow all day, and I can tell you with confidence, they're still here. When the price dropped from $66.50 back down to $65.80, we saw enormous block orders appear on the bid side. Someone stepped in around $65.75 and said, I'll take all of it. That's not the behavior of a trader looking to exit. That's the behavior of an accumulator defending their position. Speculators sell into strength. They take profits when the price is running. But this buyer is doing the opposite. They're buying into weakness. They're supporting the dip. They're putting a floor under the market to prevent it from collapsing back below $65. Why would they do that? Because they know something the retail market doesn't. They know that if $65 holds, if this level becomes established as solid support, the next leg isn't just to $67.7 or $68. The next leg is to $70, then $80, then potentially $100 or higher. They're not here for a quick flip. They're here to accumulate as much physical silver as possible before the real supply crisis hits. And that brings us to the part of this story that should terrify anyone who's short this market. The banks. For years, the commercial banks, the JP Morgans, the Bank of Americas, the HSBCs of the world have been running a very profitable trade. They sell paper silver contracts when the price is high, then buy them back when the price is low. They act as the stabilizing force in the market, the governor that keeps the price from running too hot. But that governor just broke. When the price crossed $65, the math on their short positions flipped from manageable to catastrophic. Let me show you the numbers. According to the latest Commitment of Traders report, the commercial banks are net short roughly 80,000 contracts. Each contract represents 5,000 ounces. That's 400 million ounces of silver they've sold on paper but don't actually own. They sold these contracts hoping to buy them back cheaper. Some of those shorts were put on at $50, some at $55, some even lower. But now the price is $65.80, and every single one of those contracts is underwater. For every dollar the price of silver rises, those banks lose approximately $400 million. Since this rally started around $60, we're looking at roughly $6 of gains. 6 times $400 million equals $2.4 billion in losses. That's not a rounding error. That's a disaster. But here's where it gets even worse. The $2.4 billion assumes they can exit their positions at the current price. But they can't. If they tried to buy back 400 million ounces right now, the price wouldn't stay at $65. It would explode higher. This is called slippage. The very act of covering their shorts would drive the price up, making their losses even larger. So the real damage isn't $2.4 billion. It could be $5 billion, $10 billion or more. And that's the trap. The banks are stuck. They can't add more shorts because they're already overextended. They can't cover their existing shorts without sending the price to the moon. They're paralyzed. This is what a short squeeze looks like in real time. It's not dramatic, it's not loud. It's a slow grinding pressure that builds until something breaks. And right now, we're watching the early stages of that break. The banks are trying to manage this situation as carefully as possible. They're trying to cover their shorts, slowly, quietly, without triggering a panic. But the whale isn't letting them. Every time they try to buy back a few thousand contracts, the whale absorbs the supply and the price holds firm. The banks are trapped, and every day that passes, their losses compound. Now here's how we confirm this is actually happening. We watch open interest. Open interest is the total number of outstanding futures contracts. In a normal bull market, when the price goes up, open interest also goes up because new buyers are entering the market. But in a short squeeze, the price goes up while open interest goes down. Why? Because the shorts are exiting. They're closing their positions and walking away. Later today, we're going to get preliminary data from the exchanges, and if we see open interest declining significantly while the price holds above $65, that's the smoking gun. That confirms the rally is being driven by short covering, which is the most bullish signal you can get. Because once the shorts are gone, who's left to sell? Nobody. The selling pressure evaporates, and the price is free to float to its natural equilibrium. But I need to give you a warning. Wounded animals are dangerous. Before the banks fully capitulate, they might try one final move to shake out weak hands. Don't be surprised if we see a sudden drop in the overnight session, maybe down to $64 or even $63. That would be the banks trying to trigger stop losses and create a wave of panic selling so they can cover their shorts into the chaos. If that happens, do not panic. Do not assume the rally is over. Assume it's the death throes of a dying short position. Unless we break below $61.50, the uptrend is intact. This is a process, not an event. Now, while all of this paper trading drama is playing out on the futures exchanges, there's a completely different story unfolding in the physical market. And this is where things get really interesting. If you call up a refiner right now, if you try to place a large order for physical silver, you're not going to pay $65.80. You're going to pay $70, maybe $75, maybe more depending on the quantity and delivery timeline. Why? Because the physical market is detached from the paper market. Let me explain how this works. The spot price you see on your screen, that 6580 number, represents the price of a futures contract for delivery in New York next month. It's a paper promise. But if you're an industrial user, if you're Samsung trying to keep a manufacturing line running, you don't have the luxury of waiting for delivery next month. You need silver now, so you call your supplier and you say, I need 10,000 ounces delivered by Friday. And they say, okay, but it's going to cost you $70 per ounce because we have to pull it from our emergency inventory. And you pay it. You pay the premium because the cost of shutting down your assembly line is far greater than the cost of the metal. This is happening all over the world right now. Electronics manufacturers are bypassing the exchanges entirely. They're going directly to the mines, directly to the refiners, and they're offering cash premiums to jump the line. This creates a shadow market that doesn't show up in the exchange volume data. It doesn't move the spot price immediately, but it drains physical inventory at an alarming rate. And eventually, when the exchanges run out of metal to deliver, the spot price has to gap up to meet the physical price. That's when you see silver jump $5 or $10 in a single session. The retail market is showing the same stress. Go to any major online bullion dealer right now and look at the premiums. Normally, when spot prices rise quickly, premiums compress because dealers want to move inventory. But right now, spot is up and premiums are widening. Why? Because dealers are terrified they won't be able to restock. They sold you an American Eagle yesterday for $68. Today, to replace that coin, they might have to pay $70 or more. They're bleeding capital. So they widen the spread. They charge you $75 or $80, or they switch to pre-order, ships in 4 to 6 weeks. You know what that means? It means they don't have the silver. They're taking your money today and hoping they can source the metal in a month. This inventory squeeze at the retail level is the canary in the coal mine. When dealers stop selling, it means wholesalers have stopped selling. When wholesalers stop selling, it means refiners have stopped selling. The supply chain is seizing up. And here's the ultimate risk, force majeure. If you hold silver in an ETF, if you have an unallocated account with a bank, you're holding a contract that says you own silver. But buried in the fine print of almost every one of those contracts is a clause that says, if we cannot deliver the metal due to extraordinary circumstances, we reserve the right to settle in cash. We are dangerously close to that trigger point. If the physical price is $70, but the paper price is $65, it's actually cheaper for the bank to pay you $65 in cash than to go out and buy $70 silver to deliver to you. So they default, they cash you out. And what do you do with that cash? You go try to buy physical silver, which drives the premiums even higher. This is the death spiral for the paper pricing system. Shortage leads to premiums. Premiums lead to cash settlements. Cash settlements lead to panic buying. Panic buying leads to even higher premiums. We're in the early innings of this loop right now, so we've covered the technical breakout, the delta squeeze, the bank losses, the physical disconnect. The mechanics are clear. The math is undeniable. But there's one final obstacle standing between you and life-changing wealth, and that's your own psychology. The next few days and weeks are going to be brutal. The volatility is going to increase. You're going to see wild swings. $3 drops in an hour, followed by $5 rips the next hour. The media is going to run headlines designed to scare you. The banks are going to try to shake you out of your position one last time before this thing goes parabolic. Here's what you need to understand. Volatility is not a bug. It's a feature. It's the price you pay for asymmetric returns. If you want calm, predictable 2% annual gains, go buy a treasury bond. But if you want the opportunity to multiply your wealth in a matter of months, you have to accept that the ride is going to be wild. Do not stare at the 1-minute chart. Do not check the price every 5 minutes. Turn off the noise. Zoom out. Look at the weekly chart. Look at the monthly chart. The trend is unmistakable. We are in a structural bull market. And before you think $65 is expensive, let me give you some perspective. In 1980, silver hit $50 per ounce during the Hunt Brothers squeeze. That was the all-time high. But $1 in 1980 had significantly more purchasing power than $1 today. If you adjust that $50 for inflation using the official CPI, it equals roughly $170 in today's money. Let that sink in. To simply match the inflation-adjusted high from 1980, silver would need to more than double from here. At $65, we're trading at a massive discount to the historic peak. Silver is not expensive. It's the only major asset class on the planet that's still in a multi-decade recovery phase. Stocks are at all-time highs. Real estate is at all-time highs. Even gold is near all-time highs. Silver is still clawing its way back from a 40-year bear market. This leads to the final question. When do you sell? If we're headed to $100, $150, maybe even $200, at what point do you exit? Here's the truth. You don't sell for cash. Cash is a depreciating asset. You only sell to swap. You swap an overvalued asset for an undervalued one. Right now, silver is deeply undervalued. Eventually, at some point in the future, it might become overvalued relative to other assets. That's when you swap. Watch the gold to silver ratio. Right now, it takes about 70 ounces of silver to buy 1 ounce of gold. Historically, that ratio averaged around 50 to 1. In extreme bull markets, it can drop to 30 to 1 or even lower. If the ratio compresses to 30 to 1, that's your signal. You swap your silver for gold, you lock in your gains without ever touching fiat currency. Or you swap for real estate. In 1980, you could buy a median American home for about 800 ounces of silver. Today, at $65, you'd need over 6,000 ounces. Wait for that ratio to close. When you can trade a few thousand ounces of silver for a down payment on income-generating property, that's your exit. Do not trade for numbers on a screen. Trade for tangible assets. Trade for acres. Trade for ounces of gold. Trade for cash-flowing real estate. That's how generational wealth is built. That's how you turn a market move into lasting prosperity. So here we are, December 17th, 2025, the day the $65 wall finally fell, the day the banks lost control. This isn't the end of the story. It's the beginning. The genie is out of the bottle. You can't put the toothpaste back in the tube. The world now knows that silver is scarce, that the price was artificially suppressed, and they're rushing to position themselves before this thing really takes off. You're already positioned. You saw this coming when everyone else was laughing at you. Now your job is simple. Do nothing. Hold your position. Let the market come to you. The squeeze is just beginning. If this breakdown helped you understand what's really happening behind the scenes, do me a favor. Smash that like button. Subscribe to Finance Folder so you don't miss the next update. And drop a comment below telling me what you think happens next. Are we headed to $70, $100, or do you think the banks have one more trick up their sleeve? Let me know. Until next time, stay sharp, stay patient, and hold fast.